Did you know that time is a very important factor in income determination, particularly in accrual accounting? We are now in topic 2 and we're covering chapter 2 of your textbook. Someone once said that the bad news is that time flies, but the good news is we are the pilot. Well, I'm not so sure about that, but in 1 Peter chapter 5, verses 6 and 7, it says, "Humble yourselves, therefore, under God's mighty hand, that He may lift you up in due time." So it is in God's time, not ours. We might be managing our time, but ultimately it is God who manages in His time. Now, if you're worried about something, verse 7 has a really good promise. It says, "Cast all your anxiety on Him, because He, Jesus, cares for you." It reminds me of this quote. It says, "Look around you and be distressed. Look within you and be depressed. But look to Jesus and be at rest." Let us start with a word of prayer. Our gracious Father in heaven, we are so thankful that we can always call upon your name, that you are the one in your time who will provide for us whatever it is that we need. So we can always look up to you so that we can be at rest. We won't suffer from all the cares and the anxiety in this world. We just want to recommit ourselves to you, O Lord, as we enter the second topic in this course, Financial Analysis and Reporting. Help us, O Lord, and may the Holy Spirit dwell among each one of us. We ask this in Jesus' name. Amen. All right, chapter 2 of your textbook is what we are covering. And we do have 8 learning objectives. In this first part of the lecture, we will cover the first 4 learning objectives. Then in part B, we'll go to the last 4 learning objectives, and we will do some exercises and problems for illustrative purposes. So let's get started. In learning objective 1, we will distinguish between cash basis versus accrual basis, and we'll explain why accrual basis is better. So what are the key concepts and practices that govern the measurement of income? Well, under accrual accounting, we recognize revenue when the seller has transferred the control over the goods or services to the buyer. And this entitles the seller to the benefits represented by the revenue. So the benefit is the benefit of receiving payment as soon as the transfer of goods or services have been done. So it's at the point of delivery. Expenses, on the other hand, are the expired costs or assets that are used to produce those revenues. So the expenses, as we know, are those expired, whilst assets, on the other hand, are those costs that still has future economic benefit. Now, expense recognition is tied up with the revenue recognition, and this is commonly called matching principle. Expenses are recorded in the same accounting period in which the related revenues are recognized. Now, what's cash versus accrual income measurement? Well, under accrual accounting, we decouple. That means we separate. We are distinguishing between the earned revenues and the expensed out costs from the cash. It means that the timing of recognizing revenues as well as expenses may be different from the point at which we receive or pay cash. So in other words, accrual accounting revenues generally do not correspond to cash receipts for the period. Also, it does not normally correspond with the cash payments of the expenses. Accrual accounting can therefore produce large discrepancies between measured earnings and the amount of cash generated from operations, or what we refer to as cash basis earnings. Accrual accounting, however, is better at matching economic benefit with the economic effort, and therefore it produces a measure of operating performance, that is what we refer to as accrual earnings, that provides a more realistic picture of past economic activities. And many believe that accrual accounting numbers also provide a better basis for predicting future financial performance of the enterprise. Let us have a look at an illustrative example here. We have Canterbury Publishing, and we are told here that in January 20X1, the company sells a 3-year subscription to its quarterly magazine to 1,000 customers. We are also told that customers pay the full subscription price upfront. They pay $300, and the company also took out a 3-year loan for $100,000, which carries a 10% per year interest payable at maturity on the 31st of December 20X3. The cost of publishing and distributing the magazine is $60,000 each year, and it's paid in cash at the time of publication. So if we look at the cash inflows and outflows, we can see that in 20X1 we received $300,000. So that's $300 times 1,000 customers. So that's 300,000, and it's received in 20X1. The cash outflows, however, in 20X1 is just the 60,000 publishing and distribution cost. In 20X2, we will again have the publishing and distribution cost of 60,000, but no more income. And in 20X3, we will again have the $60,000 production and distribution, plus the payment of the interest for the loan that has been taken. If we are calculating the interest over a 3-year period, we will multiply 1.1, so 1 plus 10%, so 1.1 to the third power for 3 years. All right, so that would give us 1.331. And so the loan interest would be 100,000 times 1.331. That would give us 133,100, and therefore the interest is the 33,100. All right. In a cash basis income summary, we will be showing this in this manner. 20X1, we have cash inflow of 300,000 and 60,000 cash outflow. Therefore, the operating cash flow for 20X1 is 240,000, a very healthy cash-based income. What about in 20X2? We don't have any income in 20X2, but we still have 60,000 cash outlay of distribution and publishing costs. So we are showing a net cash outflow of 60,000 in 20X2. And in 20X3, we have the 60,000 plus the 33,100 loan interest, and so that is 93,100 cash outflow. All right, so it doesn't look very good in terms of operating cash flow if we are calculating our income based on cash. What about if we are doing it on accrual basis? Let's suppose that in 20X1, common stock was 50,000 and cash 50,000. So we debit cash, credit common stock 50,000. Then we'll go on to the transactions that has been provided to us earlier. So let us record the subscription for 3 years. All right. So we are getting $300 per customer for 1,000 customers. So that would give us 300,000. So we'll debit cash. We receive cash and credit deferred subscription revenue for 300,000. So we are recording this not as revenue but as deferred subscription revenue at the first instance. Then we receive 100,000 from loans, so that's debit cash, and credit loans payable for $100,000. And for the cost of publishing and distribution, 60,000, we will be debiting publishing and distribution expense and credit cash for 60,000. Now, the adjusting entries at the end of 20X1 would be to recognize that portion of the deferred subscription revenue that has already been earned during that year, 20X1. So, we will recognize that 1/3 of this 300,000 has already been earned because it pertains to 3 years. So deferred subscription revenue will be debited for 100,000 and we will be crediting now subscription revenue for 100,000. We will also recognize at this point in time the interest expense pertaining to year 20X1. So that should be 100,000 at 10%. So that's 10,000, right? So we'll debit interest expense for 10,000 and credit interest payable for $10,000. Next, we go to the next year, 20X2. We will be debiting this time the expenses for publishing and distribution. So debit publishing and distribution expenses and credit cash for 60,000. Our adjusting entries at the end of 20X2 would be similar to our adjusting entries in 20X1. We will now recognize the portion of deferred subscription that is now earned. So we'll debit deferred subscription revenue for 100,000 and credit subscription revenue for 100,000. We will also recognize the interest expense for this period. So we have borrowed 100,000 and we have accrued $10,000 in interest expense at the end of 20X1. So by right, by the end of 20X2, we already owe $110,000 at 10%. So that would give us an interest payable of 11,000. So we'll debit interest expense for 11,000 and we will credit interest payable for 11,000. We're not going to pay the interest until the end of 20X3, but we are accruing our interest expense in 20X2. Let's move on to 20X3. Again, we will incur the publishing and distribution expenses for 60,000, so we'll debit that expense and credit cash for the same amount. At the end of 20X3, we'll need to make adjusting entries. So we will now record the last 100,000 that has been deferred and now earned. So we'll debit deferred subscription revenue for 100,000 and credit subscription revenue for 100,000. We will also record the interest expense at the end of 20X3. So remember, we have been owing them 110,000 already, plus the 11,000 that we accrued in 20X2. So we actually owe the bank 121,000 at 10%. So that means we will accrue interest of 12,100. So we'll debit interest expense 12,100 and credit interest payable for 12,100. Now we will pay the loan because it's supposed to be due at the end of the 3rd year. So we'll debit loan payable for 100,000, debit also the interest payable. We have a total of 33,100 for the 3 years, 20X1, X2, and X3, and we'll pay cash. So therefore we'll credit cash for 133,100. Now let us prepare the income statement using the accrual basis. You'll notice that for each year, 20X1, X2, and X3, we are recognizing $100,000 of revenue. Then we will deduct the corresponding expenses that have been incurred for those 3 years. So publishing and distribution is a yearly cost of $60,000. There is also a yearly interest cost of $10,000 in X1, $11,000 in X2, and $12,100 in X3. So therefore, our net income in 20X1 is $30,000, in 20X2 is $29,000, and in 20X3, $27,900. Compare that with the cash-based earnings that we have recorded earlier. In 20X1, we have $240,000 of operating cash flow, negative $60,000 in 20X2, and negative $93,100 in 20X3. When you sum up the 3 years, it will be the same, whether it is cash basis or accrual basis. But which do you think is a better representation of Canterbury's income? Well, I think you would agree that it would be the accrual basis, because at least we are matching the revenues earned with the expenses incurred for each of the 3 periods. So in reflection, the observations from accrual accounting is such that accrual accounting distinguishes the income earned and expired costs from the operating cash flows. It better matches economic benefit, that is the revenue from subscriptions, with the economic effort, the magazine publication and distribution expenses, and the interest costs. As a result, it produces a measure of operating performance that provides a more realistic picture of past economic activities. So you can see, if you graph the income or earnings over the 3-year period, the accrual basis would have a more steady net earnings compared to the operating cash flow that was very high in 20X1, and then it went downhill from 20X2 and 20X3, whereas under the accrual basis, it is kind of steady, as what we have seen in the accrual basis income summary. Let's articulate the income statement and the balance sheet. 2 things happen when income is recognized in the financial statements. The first one is that the owner's equity is increased by the amount of income. So whenever we have net profit or net income, owner's equity increase. But whenever we have net loss, we are decreasing the owner's equity. So that's one area affected by income. What else is affected? The net assets will also be affected. And by net assets, we mean the gross assets minus the gross liabilities. Whenever there is a net income, owner's equity increase, and so with net assets. Whenever there is a net loss, owner's equity decrease, and so with the net assets. Therefore, there are 2 identical ways of thinking about income recognition, and that is, think of the accounting equation. Assets minus liabilities, that's on one side of the equation, is equal to the owner's equity. So any income will increase net assets as well as increase owner's equity. But any net loss will have the opposite effect on both sides of the equation. Net loss decreases net assets and also the owner's equity. So net asset valuation and income determination are truly interrelated. Let's move on to learning objective 2. Here we'll describe the general concept behind accrual-based revenue recognition and the matching principle as applied in recognizing expenses. So let's go back to the way income affects the balance sheet. Let's focus on revenue recognition. We'll call this step 1. Whenever we sell, it will affect, as you can see, the two sides of the equation. Whenever we sell, we receive cash, for example, or we have accounts receivable. All right? So it will increase the assets. And what else will be affected? The owner's equity will increase whenever we have sales revenue. Next, expense matching is step 2. What do you think is the expense that needs to be matched to that sale that has just occurred? Well, our inventory will decrease, and we decrease in asset. At the same time, it should increase our expense, the expense called cost of goods sold. And so any increases in expense will decrease owner's equity. All right? So the subsequent balance sheet would look something like this. In the assets section, we will have cash of $130. And in the owner's equity and liability section, we will have 100 of initial equity plus the net profit from the sale. $130 was sales revenue minus the cost of goods sold of $100, so that gave us $30. So the total of that is $130, and as you can see, your assets should always be equal to your liabilities plus owner's equity. All right, so that is just a very basic review of what we have learned in previous accounting courses. Now, the critical accounting question is this: at what point is it appropriate to recognize that a firm's net assets have increased in value and thus recognize income? If you look at the operating cycle, what point is it appropriate to recognize the firm's net asset? Is it at marketing the product, at receiving the order, at negotiating the contract? Is it at the time we order materials or when we manufacture the product? Well, our answers to all that would be no, isn't it? Because we know that we can only recognize the revenue when an entity satisfies its contractual obligation to provide the goods and services to the customers. So at what point is it appropriate to recognize the firm's net assets having increased in value and therefore recognize income? It's at the point of delivering the product to the customers. All right, that's the step 1 that we talked about. Now, step 2, the matching principle associates the costs or the expenses with the revenues that we have recognized in the period. So it is also at the point of delivering the products to the customers that we will recognize an expense called cost of goods sold. All right, so we are transferring from an asset called inventory to an expense called cost of goods sold at the point when we have already transferred these goods to our customers at the point of delivering the products or service, not at the point we receive cash. All right, because if we do that, if we recognize it at the point of collecting cash, then we are using cash basis. So it is at the point of delivering the product that we recognize that revenue has been earned and that expenses has to be matched accordingly. Recently, both the FASB, the Financial Accounting Standards Board, and IASB, the International Accounting Standards Board, issued a joint pronouncement that revamped the standards for recognition of revenues. The new standard replaced a patchwork of rules many of which were industry specific with a single framework for when revenue is to be recognized. So before this pronouncement by FASB and IASB, there are kind of different acceptable accounting practices that are specific to an industry. But once this pronouncement has been passed by both FASB and IASB, it overrules those industry-specific practices. All right. More of this is covered in chapter 3 of your textbook, but we will not be going into that detail. Suffice it to say that it's important we know to think of the point at which revenue is to be recognized, being what? It's the point at which the entity has satisfied its obligation to provide goods or services to a customer. So the point of having delivered the product or service. Now, let's go to matching principle. Once the revenue for a period has been determined, the next step in determining income is to accumulate and record the costs that are associated with the revenue generated. So there are two types of costs that are associated with generating revenue. The first one is traceable cost. So as the name suggests, these are costs that are easily traced to the revenue that has been earned. The second one is period costs. These are costs that are really important in generating revenue, but their contribution to a specific sale is difficult, if not impossible, to quantify. How do we match the traceable costs? Well, traceable costs are recognized as expense in the same period when the corresponding revenue is recognized. Just like what we did in the example. When we have already sold the products, then we recognize the revenue and we also record the cost of goods sold. So product costs are mostly all considered traceable costs. This includes the cost of physically producing the goods. So product costs often constitute a large portion of the traceable cost. If the company is manufacturing, it includes the direct materials, direct labor, and all the manufacturing overhead, including factory maintenance, factory rental, machinery depreciation, the cost of the supervisors' salaries, and the like. Now, it's difficult to associate overhead costs with specific units of production, but these manufacturing overhead costs are generally allocated to inventory costs on some rational basis, and therefore they are expensed out as part of the cost of goods sold. All right, let's have a look again at Canterbury Company and look at their traceable as well as period costs. So recall that Canterbury's publishing sells subscriptions of the magazine to the customers. So Canterbury's product costs would include the cost of physically producing each copy of the magazine, and those are traceable to the revenue for that copy. There are, of course, other traceable costs like the distribution cost. We can assume in Canterbury case that these can be traced to the products. So it's possible to identify the delivery cost with the physical delivery of the magazines. Even though distribution costs are actually not product costs, they are still recognized as expense in the same period as the revenue has been recognized. Now, recall also that Canterbury Publishing incurred interest expense. Remember, that's 33,100 over the 3-year period. Although interest is a necessary cost, it's not possible to associate interest with any specific copies of the magazine. And so, this is considered a period cost, and it is expensed in the period the benefit was derived. Period costs are not expensed on a cash basis. It's important to note that. The interest was all paid in 20x3. 33,100 was paid in 20x3, but it was still expensed over the years the loan was outstanding, which is the period of time Canterbury benefited from the use of these borrowed funds. Remember that we have debited expense of 10,000 in 20x1, 11,000 in 20x2, and 12,100 in 20x3. All right. Let's move on to learning objective 3. Here, we will learn the format and classifications for a multiple step income statement, and we will learn how the statement format is designed to differentiate earnings components that are more sustainable and those that are transitory. Virtually, all decision models in modern corporate finance are based on expected future cash flows. Financial reporting seeks to satisfy users' needs by providing financial information in a format that gives users reliable and representative baseline numbers to generate their own forecasts of future cash flows. So the income statement normally have to separate earnings into two components. The continuing operations, these are the sustainable or likely to be repeated in future reporting periods. That's why it's called sustainable. And the other is discontinued operations, and these are what we refer to as transitory. So here in Exhibit 2-2, we have Mythical Corporation's income statement for 3 years, 20x3, 20x2, and 20x1. You will see from here that from this point, net sales all the way to this part here, this shows the income from continuing operations. From this point onwards, as you can see, this relates to unusual or infrequently occurring items. So, material events that arise from a firm's ongoing continuing activities that are unusual in nature or infrequent in occurrence is actually shown separately from those that are normal operations of the business. What else is highlighted in this exhibit? We have transactions that are related to certain operations that the firm intends to discontinue or has already discontinued. And this is shown here, discontinued operations. And there are separate notes to this, note 2, and the unusual or infrequently occurring items is note 1. So we can see more information from the notes to the accounts. All right. Let's move on to learning objective 4. In learning objective 4, we'll learn the presentation of discontinued operations and the unusual or infrequently occurring items, including the presentation of net income attributable to non-controlling interests. So let's focus on unusual or infrequently occurring items first. This could be gains or losses that arise from a firm's continuing operations but that are not typical or recurring costs. It could be reported as separate line items in the continuing operations section of the income statement. And examples of this could be the write-down or the write-off of receivables or inventory, equipment leased to others, and intangibles. So some companies might have to write down inventory because it's still showing in their accounts and it might have been damaged already or it might have been stolen, but it's still showing in the accounts. So this might have to be written down. Other examples could be gains or losses from exchange or translation of foreign currencies, or it could be gains or losses from the sale or abandonment of property, plant, or equipment. It may even be a special one-time charge from corporate restructuring, gains or losses from sale of investments, or losses from floods, fires, or other disasters. All right, let's move on to discontinued operations. Transactions related to certain operations that the firm intends to discontinue or has already discontinued are separated from other income statement items. Discontinued operations will not generate future operating cash flows. The classification on income statement is such that the operating results of discontinued operations are excluded from continuing operations in the current period when the decision to discontinue was made. In addition, they are excluded from continuing operations in any prior years for which comparative data are provided. So in Exhibit 2.2, you notice that if the comparative data for 20x3, 20x2 were provided, the exclusion of discontinuing operations in prior years could be shown as well, just like what you can see here for both 20x3 and 20x2. The net income for those prior years will be the same as originally reported. So the net income is shown here, right? So the net income will be the same as those reported in prior years, but the amounts are removed from continuing operations that are shown higher up here. So they are removed from continuing operations and moved to this part here, discontinued operations. But the net income will still be the same for prior years. All right. What are the criteria to recognize or to show discontinued operations in the income statement? Well, the component of an entity must comprise operations and cash flows that can be clearly distinguished from the rest of the entity. So, if the component has been disposed of, right, it is treated as a discontinued operation if the disposal represents a strategic shift that has or will have a major effect on an entity's operations and financial results. So a strategic shift might be that the company might decide to diversify, or maybe they were well diversified before, but they are shifting into a particular focus of their business. All right. Now, what happens if the component has not yet been disposed of? Well, it must first be determined whether it is classified as held for sale. If the component is deemed to be held for sale, then it also must meet the strategic shift criterion in order for it to be given discontinued operations treatment. So the question that begs to be asked is, what do we mean by held for sale? Well, a disposal group is considered held for sale if it meets the following 6 conditions. Number 1, management has committed to a plan to sell the component. Number 2, the component is available for immediate sale in its present condition, subject only to the terms that are usual and customary. So if the component needs to be remodeled or it needs a lot of renovation, you need to pump in a lot of funds in order for it to be sold, then it won't meet this second criteria. Number 3, there must be an active program to locate a buyer, and it should have already been initiated, as have all other necessary actions. So if they have already gotten a real estate agent to sell that component of the business, then it meets this criteria. Number 4, the sale is probable and is expected to be completed within a year. So if the company said that, all right, we're holding this component for sale, but it will not happen within a year, it will be in 5 years' time or 4 years' time, then it won't meet criteria number 4. Number 5, the component is being actively marketed at a reasonable price. So reasonable price is the key. If the component is being sold at a very high price, a price that is not likely to be sold for, then it's not considered held for sale. And finally, number 6, it is unlikely that significant changes will be made to the disposal plan or that it will be withdrawn. So if the company said, yeah, we're holding it for sale, but we're not really sure whether we have to change something before we can sell it and all that, then it won't meet this criteria. On the other hand, if all these 6 conditions are met, then it satisfies this held for sale, and as a result, this, what we've said here, if the component has not yet been disposed of, but it is considered held for sale and the component meets the strategic shift criterion, then it can be considered as discontinued operations and it will have to be shown separately in the financial statement. All right. Let's move on to these amounts that need to be reported when a disposal group has been sold. So when the discontinued component is sold before the end of the reporting period, then the company's report will have 2 elements as part of the discontinued operations. Number 1, it must have the operating income or loss, that's the revenue minus expense from operating the component from the beginning of the reporting period to the disposal date minus the related tax. That's one element. The second element would be the gain or loss on disposal. And this is computed as the net sale price minus the book value of net assets disposed of, again, net of any related tax effects. All right. What about when the component is considered held for sale? If a component becomes a discontinued operation in a reporting period, but it has not been sold by the end of the period, then the income effects of the discontinued operations will be reported in 2 elements as well. The first one is the operating income or loss. That's the revenue minus expense from operating the component net of tax effects. And the second element would be an impairment loss, net of tax effects as well. So an impairment loss will be shown or disclosed if the book value of the net assets in the disposal group is more than the net assets fair value minus the selling costs. All right. Now, whether we have sold it before the period or after the period, we still need to report it net of tax effects. So this is what we're going to talk about here, reporting as net of tax effects. So net of tax treatment is called intra-period income tax allocation. So the income or loss from operating the discontinued component is reported net of tax effects. Any gain or loss from disposal or impairment are also reported net of tax effects. Intra-period income tax collection matches the income tax burden or benefit with the item giving rise to it. And that's very important. You will see that in the exhibit showing the income statement in Chapter 2 of your textbook. Now, what's the proportion of firms reporting these non-recurring items? As you can see in this graph, there are 3 main non-recurring items reported by firms. The one that is most commonly reported are the unusual or infrequently occurring items. That's the blue. The second most reported is the discontinued operations, and that is shown in gray. And of course, the extraordinary items is the third. Another category of transitory items reported separately on the income statement that existed under US GAAP until recently is these extraordinary items. This one here shown in black. To be treated as an extraordinary item, the event or transaction must have been both unusual and infrequent in occurrence. Effective 2016 for calendar year firms, US GAAP no longer permits extraordinary item treatment. So instead, such gains or losses are reported as part of the continuing operations section of the income statement on a before tax basis, with the tax effect included in income tax expense. So extraordinary item treatment was no longer permitted after 2016 by US GAAP. But IFRS never actually permitted the extraordinary item treatments. So in this regard, the International Financial Reporting Standards, IFRS, and the US GAAP are now having the same treatment. Extraordinary items are no longer separated from continuing operations. That's the reason why you can see that from 2015 onwards, extraordinary items are no longer disclosed separately by US firms. All extraordinary items are now included as part of continuing operations. All right, well, we will pause here for a while and we will continue with part B of this lecture in a short while. Bye-bye for now.